Now, very recently, Citigroup reported a third-quarter loss. A third-quarter loss was absolutely a mathematical impossibility. Virtually every security and virtually every sector that they're in was up in the third quarter and up a lot. So what this means is they were catching up from previous periods. You know, it couldn't be that they lost money in the third quarter. They were either inadequately reserved as of the end of the second quarter or overmarked as of the end of the second quarter. So they did not lose money in the third quarter. And in the midst of the crisis, sort of time and time, you know, sort of the pattern was a more or less government-sanctioned report on an institution that you cannot see or analyze states this institution is okay. There's a run on the institution. They all go, on a Friday afternoon, they go into their halls, 100 people, 100 conference rooms, maybe 1,000 people, 100 conference rooms. They'll be there all weekend, scrounging over the books, and they come out Monday morning, and it's, this is really bad. We don't know exactly how bad it is, but though the government said it was solvent. On Monday, now that we've looked at it, it's terrible. There's a deep hole, and we don't know how deep it is. So horrible disclosure in the past, and that sort of continues today. The fourth point, a bit of a, I'm sorry the great vampire squid isn't here to engage on this, but at this point, the subsidies to the too-big-to-fail institutions are really huge and significant. If Goldman has a $1 trillion balance sheet and their cost of funding is reduced by something like 100 to 200 basis points, that's a $10 billion to $20 billion a year subsidy on an institution that has a book value of about $30 billion. And I think if you lay the problem out this way, I think that the route to the solution are first disclosure for commensurate with the public involvement, public interest, public level in financial institutions. I see no reason why a Goldman or Citibank, whatever, ought not to be required to disclose sort of CUSIP level, line-by-line detail over everything they have. And at first it'll be meaningless, but one would get the benefit of massive parallel processing as sort of everybody in the world goes to look at what they have and can figure out an opinion on their solvency, liquidity, et cetera. I think if that had been in place, the institutions wouldn't have gotten to the point that they were, and you wouldn't have had the weekend sessions where all of a sudden people are trying to make sense of well over 1 million contracts, transactions, lines on a set of books. The second thing I think is, should happen is we should move away from strategic ambiguity and towards a system of explicitly unguaranteed or explicitly guaranteed and explicitly unguaranteed money. And the explicitly guaranteed money should not be free. It's not rocket science to determine something like an appropriate rate, and the institutions that that benefit from it or have significant sort of public exposure ought to pay for it. I think the combination of disclosure and paying for the subsidies that one is getting will cause institutions to voluntarily shrink.
We'll now give each of these panelists an opportunity, any of them who wish to have a brief follow-up or a question of another panelist, or anything additional that you'd like to say, keeping it brief so that we can save time for questions.
Thank you. I'm reminded, with all the discussion of the Fed, of the best definition of a central bank, which I've read, which is that of Charles Goodhart. The central bank is the manager of the banking club, just as Bill's former employer, the former Federal Home Loan Bank Board, was the manager of the Savings and Loan Club. To Bill's point, making people loans they can't afford is always a bad idea. And we always need to remember that in public policy as well as lending. And fraud is a crime, but we shouldn't be surprised by its emergence. Bubbles, big booms and bubbles are invariably accompanied by frauds of various kinds. As Walter Bagehot observed in 1873, the good times of too high price always give rise to much fraud, and it's still true. The most important idea, I think, is this notion of mistakes. Though mistakes are more important than fraud. Mistakes are made by lenders, mistakes are made by borrowers, mistakes are made by central bankers, by regulators, by politicians, by everybody. To quote Bagehot again, the losses to which a sanguine and plausible manager would commit a bank in complete good faith are beyond comparison greater than the losses which a dishonest manager would be able to conceal. I think that's generally true. So when we're trying to think about how a re-privatized, or maybe we can get back from 70-30, John, to 50-50 or 40-60, but moving directionally toward re-privatization, one of the questions we want to ask ourselves is, what kind of a financial system makes the inevitable mistakes less destructive? So the notion that you're going to avoid mistakes by some kind of mechanistic rules or regulation is just foolish. There will always be mistakes. The question is, how do you make systems which are robust to the making of mistakes? And one answer to that is you don't have the centralized authority of Leviathan being able to dictate mistakes. Another answer is, as John suggested, you need much less leverage in the system or greater capital ratios. That makes them more robust to the inevitable mistake making. And third, which has not been mentioned, we need to go back to a very old-fashioned policy, which is much greater loss reserves built in good times against the inevitable bad times, which we know are coming, and the notion that we don't provide for the inevitable bad times and the good times. This includes size of deposit insurance funds, if you're going to have one, is a lesson we need to really learn this time. My final point is that this lesson about providing in the bad times is a very old lesson. It's found in explicit fashion in the book of Genesis, chapter 41, which, as you will remember perhaps, is the story of Pharaoh's dream of the 7 fat cows and the 7 lean cows, and we could take that lesson to heart.
Well, if we're going to go biblical, all those that doeth evil hateth the light. So frauds also cause bubbles. It's not just the other way around. In the savings and loan crisis, the National Commission to look into it said that the typical large failure fraud was invariably present. I don't think anyone much doubts the Enrons and WorldComs of the world, and were we to investigate here, I think you'll find the same thing.
Let me just say I fully agree that frauds and bubbles are self-reinforcing phenomena.
Here I would say we didn't suffer from sanguine and plausible managers making loans with no underwriting to the hairdresser who purports to be making $600,000 a year. This is something characterized by a very different world where adverse selection was the norm, and adverse selection is well known in economics to produce negative expected value, which is a fancy way of saying we know if you do this, you will go bankrupt.